FBARs, voluntary disclosures, and foreign accounts. A recording of the webinar will be posted on the website later this week. And please type your questions into the chat box in the panel on your monitor, and questions will be answered at the end of the webinar. Let me introduce Dennis Brager. Dennis is a California State Bar Certified Tax Specialist and a former senior tax attorney for the Internal Revenue Service's Office of Chief Counsel. He is a regular speaker at the UCLA Tax Controversy Institute and has been retained as an expert witness in both federal and state courts. Dennis is the founder of the Brager Tax Law Group, a 5-attorney firm located in Westwood. The firm's practice is limited to criminal and civil tax controversy matters with the IRS, the state of California. Dennis has been named as super lawyer in the field of tax litigation by Los Angeles Magazine every year since 2006. He has been quoted as a tax expert by Businessweek, Accounting Today, BNA Tax Report, the National Law Journal, the Daily Beast, USA Today, Money Laundering, the Los Angeles Daily Journal, Tax Analyst, among others. Dennis has been a guest on ABC Television's Good Morning America, Fox Business News, TV One Access, and KFWB Money 101. Welcome, Dennis.
Thank you. Thank you, and good morning to everybody. And thank you to all of you who are attending. I have to give a special thank you. I know there are a couple of people from the IRS that are listening in today. So unfortunately, I won't be able to give away the true secrets. But don't worry, there's plenty that I hope you'll find helpful here. So let me start by describing the problem. The problem is that U.S. persons who have signing authority over or a financial interest in an offshore account have to file an FBAR. And I used to say, as you see here in the outline, that it needs to be filed on Form TDF 90-22.1. Well, very recently, FinCEN has issued a new form. The 90-22.1 is no longer the FBAR form, and the new form is a FinCEN 114. The information collected on the form is very similar to the old TDF form that you're probably familiar with. So anyway, if you or your client has signatory authority or financial interest in an offshore account and their combined balances of over $10,000 U.S., then an FBAR must be filed. And each of these terms, whether it's U.S. person or financial interest, has a very specific meaning. And let's just go over those. U.S. person is simple enough. It means a U.S. citizen, or it also means somebody who's a resident of the United States. And currently, that includes resident aliens under IRC 7701B, and this differs from the rule that was in effect prior to the FinCEN regulations being issued effective March 28, 2011. So now the test of who is a U.S. resident is the same as under the Internal Revenue Code. And that includes the green card test. If your client has a green card, they're automatically considered a U.S. resident. Or if they have a substantial presence in the United States. So generally speaking, that's somebody who's here 183 days during the calendar year. Or there's also a 3-year test where you use a fraction of their presence in each of the preceding 3 years. And I'm not going to get into the details on that at this point. You can take a look at that if when it comes up. As I said, the substantial presence test didn't exist prior to March 28, 2011. The phrase resident was not defined and is not defined in the enabling statute. And the IRS had issued guidelines in the Internal Revenue Manual on what it meant to be a resident of the United States. And in general, it meant somebody who had come here with the intent to reside indefinitely or permanently. So under the old rules, you could have a situation where somebody was here, let's say, on a student visa or for some other reason where they were here just temporarily. They were here more than 183 days, but because they didn't have the intent to remain here permanently, they were not considered a resident, and therefore they didn't have an FBAR filing requirement. So what's the definition of a financial interest? Well, it's somebody who is the owner of record or holder of legal title. Basically, if your name is on the account, you have a financial interest in the account, whether or not that's your money in the account. Also, a U.S. person has a financial interest in each foreign account for which the owner of record or holder of legal title is a nominee of the U.S. person. So if you put your money in somebody else's name and you're a U.S. person, then you have a financial interest in that account. Also, if you own more than 50% of a corporation, and that corporation in turn has a overseas bank account, then you, the individual natural person, has a financial interest in that account, and you have an FBAR filing requirement even if you don't have signatory authority on that account. If you're the grantor of a trust and you have an ownership interest under the grantor trust rules, then in that situation, you're considered to have a financial interest in the account. If there's a trust and you have a present beneficial interest, note that's present beneficial interest, in more than 50% of the assets, or you receive more than 50% of the current income from that trust, then you have a financial interest in that foreign asset or foreign account, I should say. Note that these definitions for the corporation and the beneficial interest in the trust say more than 50%. So if you have two U.S. persons, each of whom have a 50% ownership interest in a corporation, then neither of them have a financial interest in the account, and therefore neither of them have an FBAR filing requirement, unless, of course, they have signatory authority over the account, in which case that's an independent reason as to why an FBAR would need to be filed. And going on with my theme of the problem, there's a Schedule B question which asks if you have an interest in or signature authority over a financial account, and then it refers you to the FBAR filing requirement. And the problem is that if your client checks no, it subjects that person to a possible criminal charge of filing a false income tax return, even though the income is properly stated on the form. It's simply the false statement. So FBARs are due on June 30th, which causes a fair amount of confusion because they're not due on April 15th or some other traditional income tax filing return. They are not filed with the tax return, but must be filed electronically, and that's a new requirement as of July 1st of this year. They must be filed electronically with FinCEN. Paper copies are no longer accepted. And the electronic FBARs must be filed even when you're filing old or back FBARs in connection with some type of voluntary disclosure. The FBAR rules are not contained in Title 26 of the Title 26 of the code. In other words, the Internal Revenue Code. They're part of the Bank Secrecy Act, and as a result, there are a few disconnects. Things that we're used to in the tax world don't necessarily translate over into the world of FBARs. So, for example, extensions of time to file federal income tax returns don't extend the filing time for FBARs. There is no provision for obtaining an extension of time for filing an FBAR. Interestingly, the statute of limitations for the IRS to assess an FBAR penalty is 6 years from June 30th, the date it was due, and that holds even though no FBAR was filed. So unlike a tax return where if you don't file the tax return, the statute of limitations never begins to run, it's a 6-year statute. So what about the various penalties that are associated with failure to file the FBAR and, in some cases, underreporting of income? Well, we start off with a willful failure to file the FBAR, and that's a fine of up to $250,000 or 5 years in jail or both. There's willful failure to file an FBAR while violating another law of the United States, and for that the penalty can go up to 10 years in jail. There's filing a false return. I mentioned that before in connection with the inappropriate checking of the no box on the Schedule B on the income tax return, and that's up to 3 years in jail. We also have tax evasion. So if the tax on the return is understated, if there's a deficiency, it's quite possible that there could be a conviction for tax evasion, and that's also 5 years in jail. And because the IRS is simply not going to be able to prosecute all of the potential criminal cases, and if your client manages to avoid that horrendous possibility, there are still draconian civil penalties for failing to file the FBAR. And it's basically a 2- or a 3-tier system depending upon how you look at it. So there's a penalty for a negligent failure to file an FBAR. And in the words of the statute, it's a non-willful violation. I tend to refer to it as a negligent violation. Somebody was careless but did not intentionally fail to file the form. And there's a penalty of up to $10,000 for each violation. Now, in my view, for whatever my view is worth, I think a violation occurs on the failure to file an FBAR. One is only required to file one FBAR no matter how many accounts one has, and therefore there is one $10,000 fine per year. The IRS disagrees, and it takes the position in the Internal Revenue Manual that if there are multiple accounts, then there are multiple violations. So a taxpayer who has 3 different accounts at any time during the course of the year would be liable for a $30,000 penalty for each year. And to give an example, since the statute of limitations, as I mentioned, is 6 years, one could have somebody with a relatively small account incurring a $180,000 penalty, 30 times the six years. And again, this is just for a negligent or non-willful violation of the statute. The courts have not ruled one way or the other as to whether the IRS position is correct or not, so I assume at some point this will develop. Now, I said there were 3 tiers. The reason I said 3 is because if the client can show that they have reasonable cause for the failure to file the FBAR, then in that situation there would be no penalty at all. Reasonable cause is pretty difficult to demonstrate, especially considering that right there on Schedule B, the taxpayer is alerted to the possibility that they might be required to file an FBAR, and so if they didn't read that, chances are the IRS is going to take the position that they were negligent. Of course, there might be situations where the taxpayer had a fairly low level of education, or where English is not their native language, and perhaps they could argue that they didn't understand, or they had legitimate reasons for not comprehending that an FBAR was due. So the main FBAR penalty, or the one that everybody is most concerned about, is for the willful failure to file an FBAR, and that is up to the greater of $100,000 or 50% of the amount in the account at the time of the violation. So a couple of quick examples. $500,000 account, that's a $250,000 penalty. It could be imposed for each of the 6 years within the statute of limitations. So now we're talking about a penalty of, $1.5 million, multiples of the balance in the account. You could have a smaller account. Let's say you have a $50,000 in the account, but in that case, the penalty could be $100,000, and you've got 6 years at $100,000. That's $600,000 worth of penalties on a small account. Now, I will say that the Internal Revenue Manual contains certain so-called mitigation provisions, which allows for smaller penalties on smaller accounts, and that's something that you would want to take a look at. There's also a willful penalty for willful failure to keep records of the account. That's a separate penalty. And then there are all of the penalties that can be imposed by the IRS under Title 26, the Internal Revenue Code. These are not, strictly speaking, penalties for failure to file the FBAR. Instead, these are penalties having to do with the failure to either file certain forms or the failure to report income. So we've got the civil fraud penalty, which is 75% of the tax due. We have potentially an accuracy-related penalty, which is 20%. And then we have the various penalties for failure to file certain reporting forms having to do with ownership interests in foreign entities, transfers of funds to foreign entities. So we've got this one here, this 3520 form, which one is supposed to file to report the transfer of funds to a foreign trust, and that's 35% of the amount transferred. And this is not a penalty that requires willfulness. So the only way to get out of this penalty, if this form is required, is if you can show reasonable cause for having failed to file 3520. The 3520 is also required to be filed to report the receipt of a gift or inheritance from a foreign person. If the gift or inheritance is over $100,000. There is a penalty for failure to report a transfer of property to a foreign corporation. And then we go on with some more penalties. There's penalties for failure to file foreign corporation information returns. Those are the 5471 and 5472s. Failure to file the Form 3520A, that's an annual form reflecting certain ownership of a foreign trust under the grantor trust rules. That's 5% of the trust assets, and again, that's an annual form. And there's a form for filing certain foreign partnership information. And probably the most important thing about this laundry list of forms that needs to be filed is that there's no statute of limitations on the failure to file the various foreign information reporting forms. So these rules came into effect, I want to say, I think it was the late 80s, somewhere around 87 or so. So you can have a situation where if, for example, 5471s weren't filed for a controlled foreign corporation, you've got, let's see, it's 2013. So you could have, who knows, maybe 16 years of penalties at $10,000 a year. If there are multiple corporations, each one is supposed to be filing a 5471, so you can double that number. It gets quite expensive very, very quickly. And of course, a lot of these penalties can accrue interest. A lot of people are under the impression that people with foreign accounts are somehow skimming income, not reporting all their income, that they are mostly tax cheats. In our experience here at the firm, and we've had a couple of hundred clients who've had foreign accounts in the last 4 or 5 years since the IRS has begun cracking down. The vast majority of these people are not what I would call traditional tax cheats. They are people who have foreign accounts for legitimate reasons. And so, for example, and these are all examples with slight changes. You know, we have a client who wants to buy a place in London so that he'll be able to retire there or stay on vacation. And so he opens an account over there. He wires $500,000 over to use as a down payment. It sits temporarily in an account, and then the home is purchased. Nevertheless, the client was required to file an FBAR. Chances are clients in that situation never give the foreign account a moment's thought. People who live in foreign countries, naturally they have a foreign account, but they're still required to file an FBAR. We have a lot of immigrant clients. They come over here. They were successful in the old country, whether it was India or Israel or Hong Kong, and they keep accounts over there. Those people are required to file FBARs. There's just, and how could I forget, Canadian retirement accounts. They're Canadians living here in the U.S. They have their Canadian retirement accounts, and generally speaking, they're required to file FBARs. So there's a long laundry list of situations where people have not failed to report the principal in the account on their income tax returns, and as a result, don't give a whole lot of thought to reporting any interest earned on it, and certainly don't give much thought to filing FBARs. So I promised in the materials that were sent out advertising this little webinar that I would answer your clients' most asked question. And notice I said question, not questions. They'll ask a lot of questions. But the one they'll ask the most, at least in my experience, is this one. How will the IRS find out? Well, there are lots of ways that the IRS may find out. As I tell clients, I don't have a crystal ball. I don't know whether or not the IRS will find out. But what I do know is that there's certainly a number of ways that the IRS could. So, of course, there's FATCA, which is coming into effect July 1st of next year. That date has been delayed a couple of times, but that's when it's due to come into effect. And under FATCA, the foreign banks will be sending information about their U.S. clients to the Internal Revenue Service. There are a whole series of IRS investigations going on into various banks. I believe that the number that it's been reported that there are 14 Swiss banks, 14 Swiss banks that the IRS is looking into and considering criminal prosecution. Some of those include Credit Suisse, Julius Baer, HSBC. The IRS is also apparently investigating Bank Leumi and Bank Hapoalim in Israel. The IRS is going to be entering into agreements with additional Swiss banks. The IRS and the Swiss government announced last, it was either July or August, this July or August of 2013, that an agreement had been entered into whereby if Swiss banks who were not under active investigation by the IRS wanted to avoid potential criminal prosecution by the Department of Justice, that they could come in, they could provide information about U.S. persons who have accounts with them, pay a substantial penalty based upon the asset values of the U.S. accounts at their banks. That is going to be happening over the next few months, apparently. I'm told that there are a number of Swiss banks that are considering that. And just so you understand, under the agreement, the banks are not going to immediately turn over the names of the U.S. persons. There'll be general information regarding the number of accounts and information of that sort. But it's expected that the IRS will use that information to, in turn, serve either John Doe summonses or treaty requests, and that will give the IRS grounds for, for doing that. So that is going to result in just a flood of information coming over to the IRS. I don't want to get into the details of FATCA. We don't have a lot of time, so I'm just going to run through that. And by the way, this outline, this PowerPoint, is going to be posted on our website within a few hours after we finish here. So you don't have to scribble madly. So some other ways that the IRS can find out about your client's account. We have whistleblowers. A few years ago, the statute was changed. People who come in and inform on their friends and neighbors can get a significant percentage of the recovery by the IRS. There was an award to a gentleman, Bradley Birkenfeld. I believe it was in the range of $100 million because he turned in a whole pile of names to the Internal Revenue Service. He comes under the category of disgruntled bank employee. He also comes under the category of bank employees under indictment. When people get indicted or threatened with indictment, they have a tendency to turn in as much information as they can in order to reduce their jail time. And then, of course, there are ex-spouses, ex-employees, ex-business partners. And, you know, when these people get unhappy, they may go to the IRS. Definitely a possibility. Going back to the foreign banks again, most foreign financial institutions, or at least many of them, are closing accounts of U.S. persons who don't want to fill out the Form W-9 and agree to information reporting by the IRS. There's at least one or possibly two Israeli banks that I'm aware of that are freezing accounts of U.S. persons if they do not step forward and fill out Form W-9s and show that that they're coming clean with the Internal Revenue Service. And then the IRS is involved in all sorts of activities. There was a summons to HSBC. There are, I say here, an interview pool of 33. I think it's about 35,000 taxpayers right now that have participated in the offshore voluntary disclosure programs. As part of participation in that program, taxpayers are required to fully cooperate with the IRS, including providing the names of the key people who helped them set up the accounts. So when the clients turn in their financial advisors, the financial advisors then start getting investigated, which again leads to people under indictment who want to give up the names of their other clients in order to reduce their sentences. So there was the indictment against Weglin Bank. Weglin was the oldest bank in Switzerland. This indictment against Weglin caused the collapse of it. Again, that's leading to more names. And so I've been sitting here for the last, I don't know, half hour going through sort of a gloom and doom scenario. The high penalties, the significant likelihood of discovery. And let me add, by the way, to the significant likelihood of discovery, go back to the point about the electronic FBAR. What the electronic FBAR means is that it becomes much easier for the IRS to identify first-time FBAR filers. And while I hate to give ideas to the IRS, I think they've probably already thought of this one. It would be a pretty easy matter to know who's filed an FBAR for the first time, and then if the account is large enough, contact those people to find out why FBARs haven't been filed in the past. So there's pretty easy for the IRS to figure this stuff out. So anyway, it's against this background of high penalties, increasing chances of discovery, that we need to talk about the Offshore Voluntary Disclosure Program, the OVDP. And we'll get into a little more details about that. It certainly is not a panacea. It's not for everybody, but it can be appropriate for taxpayers in the right situation. So first of all, let's talk about who's not eligible. Basically, it's not for taxpayers who are under audit. It doesn't matter if the audit is related to an offshore issue. Your client can be under audit related to his charitable deductions, and he will not qualify. Obviously, taxpayers under investigation by IRS's CI, Criminal Investigation Division, will not be eligible, nor will taxpayers with illegal sources of income. There were really 3 OVD programs, and the first one had a 20% penalty. It closed out in October 2009. There was a new program that started up a little later, raised the penalty to 25%. That one got closed out, and then shortly thereafter, yet another program came into effect, the 2012 OVDP. It was announced in January of last year. It provides for a 27.5% penalty, and currently there is no specific ending date for it, although the IRS has made clear that they reserve the right to end the program at any time. And furthermore, they reserve the right to declare certain classes of taxpayers ineligible. So, for example, they might decide that if there's some bank that's on the radar, whether it's Hapolim or Bank Leumi or one of the Swiss banks, and the IRS feels, well, people sort of have had enough advance notice that they need to get into the program. If they haven't, the IRS could say, hey, people at Bank Leumi are no longer eligible. So there's a premium, shall we say, on clients entering the program, if the program is appropriate, sooner rather than later. If one goes into the program, there is a pile of documentation that's required to be submitted. Again, all of this is listed on the IRS's website, and there's no reason for us to spend any substantial amount of time going through this, but there will be amended returns to be filed. There will be copies of the original returns. The IRS will, as part of the process, request copies of bank statements so that they can verify that the income that the client is reporting on the amended returns are accurate. The client, or actually the client's representative, is required to prepare an account summary with a penalty calculation. There needs to be a check and full payment of all of the tax interest and all applicable penalties submitted. There's just a laundry list here. I think that this last requirement here is worth pointing out. This is the last. Let's see what happened. There we go. The last bullet point here is that the client is going to be required to extend the statute of limitations on both assessing tax interest and penalty as well as the FBAR penalties. So what are the penalties under the OVDP? As I mentioned, it's 27.5% of the highest account balance at any time during the prior 8 years. So at this point in time, one would be going back to 2005, and one would calculate again, the highest balance at any time. Now, in addition to that, it's not just 27.5% on the financial accounts. It's 27.5% of all of the taxpayers' foreign assets if those assets are in any way related to tax noncompliance. So, for example, the client owns that flat in London. It's worth $1 million, let's say, and they're collecting $2,000 a year of rental income. Well, guess what? That $1 million piece of real estate, which was not required to be included on the FBAR, is included in the penalty base, and there will be an additional $275,000 penalty. On top of this, there's an accuracy-related penalty of 20% of the tax due. And if the returns were filed late, there could be failure to file or failure to pay penalties, which would be imposed. Under the program, the taxpayer may not argue lack of willfulness, can't argue reasonable cause. If you're in the program and if you stay in the program, this is the penalty that you're going to wind up paying. There's simply no room for negotiation within the program. The only negotiation occurs around, the value of certain assets, what's included in the penalty base. Those kinds of issues definitely come up, but there's no room to argue that the penalty should be, 22% instead of 27.5%. Now, the IRS has provided for certain relief from the 27.5% penalty. There's a program for non-citizen non-filers. It's called the Streamlined Compliance Procedure. It was announced in August of 2012. In order to be eligible, you must have resided outside of the United States since January 1st of 2009. And this is the interesting part. If you file a tax return, then you're not eligible for the program, which seems a little backwards to me. Somebody who has taken the trouble to file a return is not eligible. In addition, the client must present what's referred to as a low-level compliance risk. And the benefits of this program, we'll get back to what we mean by a low-level compliance risk in a moment, but if the client qualifies, there are no penalties, only 3 years of amended tax returns need to be filed, and there's not this long laundry list of documentation that's required. So how is compliance risk determined? The tax due for the prior 3 years must be less than $1,500 for each. In other words, for each of the prior 3 years, it's got to be less than $1,500. Although the IRS has said that in some cases, that in some cases they will allow people with tax due of more than $1,500 enter the Streamlined Compliance Program, but there have been no specific guidelines issued as to how far over the $1,500 one could go. By the way, even if the tax due is less than $1,500 a year, there's no guarantee that it's a low-level compliance risk. There are factors that the IRS looks at in order to determine whether there's a low-level compliance risk, and these include whether or not the returns were submitted, claim a refund, if there's material economic activity in the U.S., if the taxpayer hasn't declared all of his or her income in their country of residence. And some of these terms are not defined at all. For example, what does material economic activity in the United States mean? Is that, a rental house? Is that, what does that mean? And here are some additional factors that the IRS will look at in terms of determining if there is a low-level compliance risk or not. So a lengthy list here. So what are the downsides? I've talked about the upside. What's the downside of Streamlined Compliance Procedure? There's several. It doesn't provide any protection from the risk of criminal prosecution. If you go into the Streamlined compliance program and you've made a mistake in evaluating the risk, the IRS is free to prosecute your client, unlike the OVDP, where once you're entered, in general, you have almost a guarantee that there will be no criminal prosecution. If you go into the Streamlined compliance program and the IRS determines it's not appropriate, you cannot go back and then participate in the OVDP. You're just hanging out there. There's a lot of work to be done. There's tax returns. There are FBARs to be filed. And most importantly, before somebody goes into this program, you need to do a very complete analysis to determine whether or not the client has criminal exposure. Because as I mentioned, if there is criminal exposure, the IRS is free to prosecute, even though somebody has come in to this procedure. Going back to the OVDP for a couple of seconds, for small accounts of less than $75,000, the penalty is only 12.5% of the highest aggregate balance. The non-financial assets, like the real estate, are taken into account for determining the $75,000 threshold if there's non-compliance associated with those assets. There's a 5% penalty that's available in certain cases. It's available with so-called inherited accounts, although that's not the term the IRS uses. Basically, it's where the taxpayer didn't open the account, they've had minimal contact with the account, and they didn't withdraw more than $1,000 in any 1 year. There's Category 2, which I refer to as brain-dead citizens. These are people who are foreign residents and who are unaware they were U.S. citizens. At the time I coined that phrase, I was unaware that apparently there's a whole industry of bringing in expectant mothers from other countries to give birth in the United States so that their children will have U.S. citizenship. And I guess there's no guarantee that those kids would necessarily know that they were U.S. citizens. We have Category 3. These are foreign residents who meet several requirements, including residing in a foreign country and having $10,000 or less of U.S. source income in each year, and they have to show that they've complied with the tax reporting and payment requirements in their country of residence. There's an additional benefit in addition to Category 3 folks having a 5% penalty. They can also exclude the value of the non-financial assets from the penalty base. Very quickly, are there any alternatives to entering OVDP? They include filing a quiet disclosure. One could also just file accurate 2013 tax returns, but not self-correct the prior years. They could enter the OVDP and then do an opt-out, meaning they go into the OVDP. That protects them from criminal prosecution. But if they don't want to pay the 27.5% penalty, they can opt out. That will subject them to an audit, but will also give them the opportunity to argue that their behavior was not willful or that there was reasonable cause. Again, before you do this, you need to do an extremely careful analysis of all of the facts and all the potential penalties and all the exposures that the client might have in undergoing an audit. Of course, there's always sticking one's head in the sand and doing nothing. I think a lot of clients would like to do that. As I say, it's hardly a recommended strategy. I've got a list of the potential risks of opting out. I'm sorry, not of opting out, but rather of For example, filing a 2013 tax return and not going back and self-correcting. There are potential problems with a quiet disclosure, although the Internal Revenue Manual still indicates that a quiet disclosure is possible. The IRS has made a number of public announcements saying that quiet disclosures are disfavored and that clients face potential criminal risk if they make a quiet disclosure. Of course, if the clients make it quiet and they don't get picked up, the rewards are high, no taxes, no penalties, no audits. Okay. Well, we're starting to run over a little bit, so I have some questions here that have been asked. So let's take a look at this. So the first question, this is an easy one. It says, can we get a copy of the PowerPoint presentation? The answer to that is yes. You can get a copy of it, and specifically, it will be posted on our website sometime later today, along with a recording of this presentation. The PowerPoint, there's actually another half dozen slides or so after this one, which I didn't have time to get to, so there's more information. The next question, I'm not quite sure I understand, is the direct or indirect per IRC Section 318. I don't know what that means, so can't answer that question. Whoever sent it in can always send me an email after the presentation directly. Okay, has the multiple violation issues ever been litigated? Has the penalty been enforced by the IRS for multiple accounts and multiple violations? The specific question of a multiple violation with regard to a negligence or a non-willful penalty has not been litigated to my knowledge. I've not seen any cases. I will say, however, that there was a willful FBAR case. It was either Williams or McBride. I can't remember which one off the top of my head. And in one of those cases, the IRS imposed 2 penalties in 1 year. And there was no discussion in the case as to whether more than one penalty was appropriate. So the IRS has certainly gone down this track, but I'm not aware of any court that's specifically ruled on it. Next question is reasonable cause. If someone didn't know he has bank accounts under his name for many years until his parents passed away, will the IRS consider that as reasonable cause? And the questioner goes on to say, it is very common in Asia where parents use their children's name to open bank accounts or hold properties. They only need stamps under the children's names to execute the transactions. Well, I certainly can't predict what the IRS will do, but I certainly think if you don't know about a bank account, that would be reasonable cause for failure to file an FBAR. Now, if as the questioner says, that it's very common in Asia that parents use their children's name to open bank accounts, maybe the IRS would argue that, gee, if you're born into a family where this is a common practice, did you ask your parents if they opened up any bank accounts in your name? And if you didn't ask, gee, maybe you didn't. Maybe there's no reasonable cause because you didn't exercise due diligence. Hard to say. I mean, I would certainly think it's reasonable cause, but there are a lot of things that have surprised me in the IRS's enforcement of this program. Are Australian superannuation accounts reportable on the FBAR? We had looked at this at one point, and our conclusion at the time, and it's been several years since I've looked at it, but our conclusion was that they are reportable on the FBAR. Next question, and the final question is, a U.S. citizen inherited stock in a foreign corporation in the 1990s. If he never filed a Form 3520, should he do so now? Well, actually, I mean, there's actually two problems here. And as far as the problem is that if the value of the foreign stock was over $100,000 at the time it was inherited, he should have filed a 3520. And I'm sorry, I just got interrupted here, so I lost my train of thought. In any event, he should have filed, if the value of the stock was over $100,000, he should have filed a 3520. But in addition, if he owned 100% of the foreign stock, or he owned a high enough percentage interest, then he was supposed to be filing 5471. So we've got that problem. But let's assume that the amount of the stock was such that it didn't require any other filings. As long as all of the income has been reported on the foreign stock since it was inherited, the client can file the 3520 now under the IRS FAQ 18, and no penalties will be imposed for the failure to file the 3520. And now one more question just came in, and it says, are there statistics regarding how many taxpayers have been criminally prosecuted versus civil penalties? I'm not aware if there are any statistics. I know that I've seen some counts of somewhere around 120 or 130 criminal prosecutions. I don't know and have not seen what the total FBAR penalties are outside of the OVDP. So I can't answer that part of the question. Anyway, that sort of wraps things up here for us today. I appreciate your attention, and that's it for today. Thank you.